This is how a typical losing trader approaches the market. He loads up a dozen indicators and clutters his chart, thinking that more indicators will translate to a higher probability setup. It's like waiting for all the stars to align, except that when it happens, the trader still loses money. So does having more trading indicators translate to higher probability? Is there a combination of trading indicators that will provide you with a 99.999% winning strategy when combined? Well, if you take the time to study professional traders and look at their charts, you will soon realize that they tend to keep their charts clean. So why is there such a stark difference between how professional traders and retail traders set up their charts? Well, that's because professional traders understand that trading indicators can only do so much for them, and that's the reason why they might have only one or two indicators on their charts. In this video, I'm going to show you how not to combine trading indicators and what to do instead. I have previously uploaded a video about how institutional traders combine leading and lagging indicators, and if you have not watched that video, I recommend that you watch that video next. I will leave a link to that video at the top right corner and at the end screen of this video. Now, before I show you the common mistake that most traders make, please do me a small favor and hit that thumbs up button. If you are new, do subscribe to the channel as well, as we create many valuable trading tutorial videos like this. To encourage you to watch and work on your trading skills, we also do a giveaway for our plug and trade package worth $37. So if you wish to participate, then look for an emoji somewhere in this video. You can also find the full instructions in a pinned comment down below. So let's talk about the common mistake that most traders make. They go onto YouTube, watch a couple of videos, could be ours, could be another Forex guru's channel, and they learn about the MACD, stochastic, relative strength index, and other technical indicators. And they conclude that, hey, since the MACD is so effective and the stochastic as well, then wouldn't it be great to combine the two and wait for both indicators to fire the signals? If both are bullish, they know for a fact that the market is bullish and they are going to make money. Now that sounds really logical, doesn't it? Perhaps some of you are thinking to yourself right now, hey, that's a great idea, why didn't I think of that? Unfortunately, trading isn't that simple. Right here, you can see that both the MACD and stochastic were bearish, but the trade resulted in a loss. So let me explain why this doesn't work. Now, the MACD, stochastic, and relative strength index falls under the category of a momentum oscillator. And because they fall in the same category, they are computed similarly. Though the calculations are not identical, it pretty much gives you the same conclusion. Over here, you can see that when the MACD is bullish, then the stochastic indicator is bullish as well. And of course, the relative strength index is showing bullish as well. Here's another example. This time, the MACD is bearish. And guess what the stochastic and relative strength index is saying? Well, bearish of course. This illustrates that you don't have three confirmations pointing that you should be buying or selling. You actually have one confirmation, viewed as three different confirmations. Let me repeat this because this is so important to understand. You do not have three confirmations. You have one confirmation that is seen across three indicators that show the same thing. This is the big mistake that most traders make when they combine indicators. Thus, do you now understand why professional traders tend to keep their charts simple with one or two indicators only? Well, because the indicators tell them the same thing, and there's no point cluttering the charts with the same information. What professional traders do is pick one momentum indicator and perhaps another trend or volatility indicator to help them. It just doesn't make sense to pick 2 or 3 momentum indicators when it tells them the same thing. Rather than asking how many indicators you should be using, the question should be how do you effectively combine indicators just like how the professional traders do. Well, to effectively combine trading indicators, we have to understand that there are 4 main categories of indicators: trend, momentum, volume, and volatility. So the trick lies in picking one indicator from one of these categories. Now, some indicators like the MACD may fall under 2 categories: trend and momentum, or the Bollinger Band, which may be classified as a volatility and trend indicator, depending on how you use it. But this is just a very general way to classify the thousands of indicators out there. The key point to remember is that there's really no point in using 3 indicators from a category, especially if the indicators tell you the same thing. Now, before you get crazy and start picking one indicator from each of the 4 categories and start cluttering your charts, please bear in mind that it is not mandatory to pick an indicator from each category. Suppose that you are trading Forex, where volume isn't important as compared to trading stocks. Then you can choose to leave out the volume category. Or perhaps you are trading a trend following strategy and are not too concerned with volatility. In this case, you can ignore any volatility based indicator. Or perhaps you are a range trader who seeks to profit when the market is in a tight consolidation with little volatility. In this case, you can opt to focus on a single volatility indicator such as the Bollinger Band. As a rule of thumb, I recommend not having more than 3 indicators on your charts. There are no best indicators out there, so just choose the indicators that you are most comfortable with. Before I end off this video, I want to highlight a critical point that differentiates professional traders from retail traders when it comes to how they use indicators. Earlier on, I explained that professional traders usually have 1 or 2 indicators. That's generalizing, of course. I'm sure there are professional traders who use 20 indicators at once as well, but generally, professional traders do not use too many indicators. And that's because they understand that indicators are the last step in their trading process and not the entire trading process itself. They will open up a chart, look at a trend, form their bias first, and look at where they want to buy or sell. Once they have determined this and want to enter into the trade, they then briefly look at the indicators to see if the indicators support this trade idea. And sometimes they might still take the trade even if the indicators do not support their trade idea. Compare this to the losing retail trader who puts on a bunch of trading indicators and blindly trades whenever the MACD fires a signal to buy or sell. Can you see the stark difference here? The professional trader uses it as confirmation and looks at it after forming his idea. The losing trader, on the other hand, forms his trading idea from the indicator. Big difference. So if that's you, that's probably why you're still struggling. If you have read the 3-day trading guide, which I've provided in the description down below, you will learn the MPE trading strategy, which starts with identifying the market context first. If you have not downloaded it or read it yet, please grab a copy of it in the description down below. So summing up this video, it is fine to use indicators, but please do not use the same category of indicators and clutter your charts with the same information. Try to stick to no more than 3 indicators on your chart, and remember that indicators will not make you profitable. Trading indicators can form part of your trading process, but it should not be the only thing you look at when you trade. You have to understand the market context and where the key levels are and combine it with indicators. And that's it for this video. Do hit the subscribe button and turn on the notification bell if you got value. As promised, I will leave a link to the video on how institutional traders combine leading and lagging indicators at the end screen here, and I recommend that you check that video out next if you haven't seen it yet. Thanks for watching. I'll see you in the next video.